What's going on, guys? It's Tremaine here, the most disciplined trader on YouTube. I got a bit of an interesting video for today's upload. Today was an example of some grade A shenanigans, I'll be honest with you. So, went short on the micro contract and I got wicked out, but on the mini contract, that wick was not there. So, had I traded the minis, we would have had a nice green day booked with a partial. But the micro pulled some last minute wicking shenanigans before selling off. And then on the bright side, however, the wick happened so fast and so quick that instead of losing $500 or $400, however much it was, I ended up only losing $100. So wicked up to my stop and came back down so fast that I didn't get filled at my stop price. I actually got filled almost at break even. So very weird day, but and I also did want to add my $3,500 payout from Apex did hit my bank account a couple of days ago. I just don't feel like making a whole separate video about it, but for those who are curious, I did get my payout from Apex, and I'll be requesting another one in a couple of weeks. So let's get to the video. All right, so I'm short here. Light risk. I haven't really risked my full leverage in a while. It's just been that kind of market environment where I don't want to risk my typical $600 to $800. I don't even have my arrows on. And I'm timing my entry at the low of the breaker. When we trade in this candle live and we trade up, hitting the low end of that, that's where I want my fill. Expecting this fair value gap to be treated as an inversion fair value gap. If the trade starts looking good, I may pyramid, but given how price is looking, I'm fine with just having a really light position on and just having a small green day, or if it's a loss, then it really wouldn't be much. I'd rather have a small loss than open up more risk on a more challenging day. And I am looking for the ATM model, which is I'm looking at that triple bottom. My voice is cracking. I don't have my water. Y'all know I stay forgetting to bring my water. So that's what I'm looking for. It's not even $1,000, which is kind of a waste of. There's too many lines going on my chart. I'm watching this inversion fair value gap. I want to see if we stay in the lower half of it. If we do that and start moving away, then I may add 3 more to my position. Because $200 is really light, I'm not gonna lie. So I'm adding 3 more there, and that's not even $500. I could have added more. I could have traded the minis today, but it's all good. $1,000 today, and I'm content if I can get that. I'm treating this fair value gap as a breakaway gap. Ideally, I wouldn't want that to be traded to at all. So I'm watching to see if we can leave that open. But we can work this inversion fair value gap, and we could work the lower half of this breaker. That's fine. That doesn't kill any narrative for me. But if we trade up into this here, then that's problematic. Again, as always, I'm also watching my 15-second chart. We're trading inside of a SIBI on a 15-second. Should we take out this low with momentum and speed, then I'll trail my stop possibly to break even. But we have to take out that low first. I like the body staying in the lower half of that inversion fair value gap. We couldn't trade to the high of it. It's a good signature. S&P and Dow look really heavy, leading the way to the downside. Want to see if NASDAQ can follow suit. Dow is really pushing lower. It's been a leader all morning. Okay, so I'm stopped out there. And let me see, because this happened last time where 2025. See, the mini contract, that wick wouldn't have stopped me out. Because that happened yesterday where there was a wick on the micro, but not on the mini. So that's unfortunate. I like the respect of the inversion fair value gap, your stop loss. I'm not managing your trade. This is how I would trade it, but my stop loss still stays here until what? We get any sort of meaningful displacement. And this is a hard market, all this wicking back and forth, but your stop loss stays here until you get a meaningful close. I'm looking at the bodies because I'm kind of ignoring the wicks, but if we get a meaningful close beneath the bodies, then I roll mine. Okay, well, there you go. Now your stop is break even here, and then take profit for your ATM model is here. I like the respect of the inversion fair value gap, the bodies, the wicks taking me out of the trade, and we saw the discrepancy there, but the bodies and the inversion fair value gap, I like seeing this. Now you could take a partial under all this, like if you ignore the wicks, and this is something that I do, like in my head, I don't actually take off the wicks, but that right there can be a partial, which is why I say the bulk of the volume is in the bodies of the candles. Triple bottom, when we trade beneath that, that can be a partial for you. You don't have to demand these long, little, shallow wicks to be taken out. I'm seeing this as a triple bottom. So if you want to scale out a small portion there, sometimes I would do that, especially on a day like today or a day where we have these long wicks. I kind of just ignore those and I focus strictly on the bodies. If you can't see that right away, then you can just do that, and then there you go. Just a little insight to how I view liquidity at times when there's a lot of wicks. But fun stream, interesting stream. I might upload this footage to YouTube because it's, I don't know, maybe somebody could learn something as far as Fed chair days and whatnot, understanding the underlying risk of trading. Who knows? I'll probably find some way to edit this up and get it up there for educational purposes, I guess. But I'll see y'all all back here for our tape reading stream tomorrow at 9:15. All right, peace.